welcome to another roller coaster ride as we get through COVID. Cathy Sabater, mortgage planner and proud living. I know you're hearing some chatter in regards to the conforming loan limits increasing. So before we get to that, just wanted to touch base in regards to unemployment. Yesterday's video had to do with, hey, where's the stimulus plan, right? Because right now they are estimating that by Christmas, another 12 million individuals' unemployment benefits will expire without a new stimulus plan. So how does this affect us? Number one, it affects everyone because we care about everyone that's going on. But at the same time, we want to make sure it's the holidays that all of our families are safe, especially our children, right? But in the meanwhile, the conforming loan limits have increased. So what does that mean to you? Well, number one, you need to know that there are different types of loans, and each loan has different requirements, and hence different conforming loan limits. So what's a conforming loan limit? A conforming loan limit means, hey, this is what the limit should be for right now. Conventional and FHA are the only two that have announced their limits. VA usually follows afterwards. Okay. So what's the difference between conventional and FHA? The biggest difference between conventional and FHA is that conventional loans are not insured. Okay. And usually you have to have higher credit score, lower debt in order to qualify for that. Okay. Now, FHA is insured by FHA, Federal Housing Administration, and so, believe it or not, you can purchase a home for as low as 3.5% down and don't have to be a first-time homebuyer. Okay, they have different rules and regulations as far as theirs concerned, but theirs is insured. Either way, just so you know, as far as conventional is concerned, for a first-time homebuyer, if you qualify, as low as 3% down. Okay, that's the minimum. Otherwise, it's 5% down if you qualify, and you don't have to be a first-time homebuyer, but you do have to actually live in the home. So with that being said, FHA, in order for you to find out what their limits are, you actually have to go to a website and check it out. So if you look below, you're going to see a little link, and it's going to be FHA lookup, right? So that you can actually look it up by county. So let's just talk real quick that as far as FHA is concerned, the conforming limit is, hey, if you meet this criteria, the conforming limit is going to be $548,250. So if your loan amount goes over that, then you're in the non-conforming area. So what does that mean? Well, that means as far as interest rate pricing is concerned, you're in a now perhaps a higher risk or a higher bracket. And as far as interest rates are concerned, it's going to be based on what? Your credit, your debt ratios, the market, right? And then the FHA ceiling. So you got this conforming limit, which right now is $548,250, and the maximum is now $822,375. That's how much you can qualify for as far as the FHA loan is concerned. Yeah, that's right. And if you qualify for as low as 3.5%, how many people know about that? So this is talking about forward loans, and then there's reverse mortgages, which is another type of loan that also their limits is the same as the regular FHA loan. So let's talk briefly about conforming limits, because this one they actually gave us the numbers. I want to just give you something really quick to think about because I chose Alameda, Los Angeles, Riverside, San Diego, Miami, Florida, and Davidson County in Tennessee. Why? Just to see what was going on nationwide, because I'm a lender that's direct and I can do loans nationwide. So because it goes by county, notice the difference that these two are 822, but Riverside County is 548, right? And for San Diego, 753, Miami, 548, and then Tennessee, 586. Who would have known? Tennessee, 586. What? Anyway, that's the story as far as this is concerned, and this is for conventional loans. So as you can see here, it says 1 unit, which means single family or condo. 2 unit means you're buying a duplex. 3 units is a triplex, and 4 units is a fourplex, which is we only do residentials between 1 unit and 4 units. Anything above 4 unit is then considered what? Commercial. And they have different rules and regulations. So what's so great about knowing about these different states and these different units? So for some families, people have heard of ADUs, accessory dwelling units, right? Everybody wants to get a piece of the pie, and unfortunately, we don't have enough inventory. So they're allowing certain states and counties to then have these accessory dwelling units where they can then either rent it out or have multi-families in it. So some of my clients are considering doing the 2 units, because if you get a 2 unit and 1 unit is rented, then guess what? You're no longer paying rent. You're letting someone else help you pay your mortgage, because they're paying rent, which is going to offset your mortgage, and then that helps you as far as your cash flow is concerned. Wanted to briefly talk about a couple of things, because if you saw some of my videos with the forbearance, you have the FHFA, which is the Federal Housing Finance Administration, with Mr. Calabria, and he's the one who says, hey, these are some of the rules and regulations we're doing as far as the CARES Act is concerned. Let me give you my opinion and some of the laws we're enacting. GSC is government-sponsored enterprises, right? Which is Fannie Mae, Freddie Mac, and FHA as well, right? What they've done as far as the forbearance is concerned is that, hey, remember, when a family's not writing a check for their mortgage because of the CARES Act, they have to, right? They have to. So that's why you have so many people are interested in getting the stimulus plan taken care of, because it also helped some of the GSEs, okay? So let's go back now to, let's talk about mortgage rates, right? So basically, the roller coaster ride again, as you can see here, what? We had, look at this roller coaster. So we hit the top, and then look how we went right back down. So when I was talking about earlier about unemployment benefits, these are the things that affect, do I invest here? Do I invest here? And then you see the 10-year treasury all the way up to 0.910. Tomorrow, I'll talk a little bit about the treasury, 10-year treasury, and how it reflects or reacts with the mortgage bonds, okay? Stay safe. And any questions or concerns, feel free to give me a call, 619-346-2675.